Good morning, everyone. When I saw the agenda and realized we had a period of grace, and knowing that the majority of the men here, of the people here, were of the male gender, and the suggestion was that shopping, most, I only said most, yeah, and that shopping had been indicated, I did not feel there would be a heavy uptake on that option. And so I wondered if we could all sit together perhaps and talk a little bit about investment principles and what we do. I have a small presentation here, and it relates to what we tend to do in the United Kingdom, and much of it is based on what I do and would therefore be available for your criticisms, positive and negative. The first thing I would say is that investment is what I do, not gambling. And it is necessary to take a long-term view. Short-term views almost invariably cost you money. What happens is you buy a share costing £1. By the time you've paid for it, it's £1.02. The following day, it drops a penny. You get fright and sell it. You get 97 pence for it. And suddenly you've lost 10% and it hasn't moved. That would be very short term. So, long term. Caution is necessary. Remember, it is your money. It is a very important part of your life. Into the future, we will be looking, I am sure, to a time when people become older but are not allowed to work because there aren't jobs for them at that time in their life. You have to make it during your working life. Among my principles, I never buy a share that doesn't pay a dividend. If they can't afford to pay me anything, I can't afford to give them my money. Only a point of view, but it is mine. I will show you later the importance of having a watching brief, in that you can't just put the money away and leave it there forever. So keep watching. My own view is that watching the stock market is far more interesting than watching a bunch of undereducated, overpaid oafs playing with inflated toys. Remember to do your own research. My parents started investing in the stock market quite a long time ago. They did a lot in mining shares. My father had a brother who was in Africa and reckoned we had the inner track on that. But certainly they made a lot of money in those days. Later, and there is a point here, more than 60% of the British people who make a lot of money make it on a single share. In their case, McDonald's of Glasgow was a department store, and it had gone from 300 euros in 1948 to 17,000 euros 20 years later, when it was taken over, actually after it was taken over by a group called the House of Fraser. Actually, I don't think they're on the market anymore. I think they went private. They're not actually bust, but they no longer have department stores. In the 50s and 60s, they made their money in a fishing and fish preparation company called the Ross Group, who were immensely profitable then. In the 70s, Tiny Roland's Lawn Row paid for all our houses and cars very, very well. And in the latter time, it's been Vodafone that has done it for us. Obviously, we have other investments, but they were the big ones, the big blocks that really paid for all the money that we finally have. A little word of caution. Be very careful who gives you advice. Lots of people have advice for you. People come to me and say, what shall I put my money in? And we don't give specific recommendations, but we say, be careful, look at the yield, We can protect you against inflation. And you see them a month later. What did you buy? Oh, I met a bloke in a pub. He's just come back from Venezuela. And it's a real goer. First question, how many shares does he have? Oh, didn't ask him. So be careful of people who come and give you some idea of a really good thing, and do your own research. In the UK, a number of people produce newsletters with specific tips. I only make this opinion, they are no better than you are yourself, okay? If they get 50% right and 50% wrong, they have won, but you have not. Another aspect of the British market is option dealing, the ability to put a small amount of money against a rise or fall in a share. You can make an enormous amount of money doing that. You can also lose your last shirt. So I personally don't do any contracts for difference or any option dealing at all. Other directors in ShareSoc do, by the way, and they reckon they're successful, and they probably are, but they're looking at it with hawk eyes every day. Spread the risk. People come and want to know how to start investing. In UK terms nowadays, I would say don't start till you've got at least £2,000, and then we'll split that immediately into two to give you the start of a spread, because a spread is desperately important. When the banks crashed 4 years ago, I was in AXA then. I used to get telephone calls from people who said, what am I going to do? It was my only investment, yeah? And finally, they said, I'm 90% disabled. And what can I say? You shouldn't have had it all in one. Well, you can't say that sort of thing. But split your risk, always. Always have a great deal of suspicion about the government. We had a chap ran as Chancellor for a while, the Cyclops of Inverkeithing, Gordon Brown was his name, and he suddenly took 10% off every dividend. He practically ruined our pension industry. He went on to become Prime Minister, and he made a proper good job of ruining the whole country. That is largely beyond the scope of this discussion. Sorry, gone too far. I think I got, yeah. Our own portfolios within my family and friends are averaging about 5.2% now. In fact, it's risen a little bit. The FTSE went up 3.9% when I last did this. A very good investor, his name is Jim Slater. Many of you will know his name, and actually we still meet in his offices for our directors' meetings. Never buys anything that doesn't pay 4% per annum. He also goes, by the way, for increasing dividend every year, hoping to double in 5 years. That is a very difficult thing to do. The figures for that are produced in proper magazines like, for example, the Investor's Chronicle, which I'll show you. We plot the income on shares. In the United Kingdom, we have a formula, a tax-free formula, called independent saving, ISA, savings accounts. If you put your money in there, you don't have to declare it for tax reasons, and you don't pay any tax on either the dividends or the capital gains after Gordon Brown had his first 10%. So it's a very good thing. It makes your life a lot easier. The amount you can put in this year is about £10,500, as it has been progressively right back to 1982, and I think it was started by Chancellor Lawson when it was £2,400. That may not be available in other countries, but we would normally put our money into there on the 6th of April, the start of the new financial year, in case the government decides to stop it. Okay, the AIM market is the alternate investment market for small companies. Instantly, slightly more risky. Currently, I think there are about 1,100 companies. There were 1,700 4 years ago. A number of them fail. You need extreme caution if you're using AIM. It does, however, have one major advantage, which is that for persons who have reached a certain age, or I should say an uncertain age, the profits, when you die, AIM stocks are exempt from inheritance tax. Okay? So if you'd had the money in one of them for 2 years, then that bit is secured from the ravages of the Chancellor. You are unlikely to benefit from that yourself. Okay, moving on a little. Nowadays, certainly in the UK, most of the people I now know do online trading at their own computers. The reason is it is massively cheaper. A conventional stockbroker will take 1.65% as his commission. An online broker, the average is round about 10 to 15 pounds a trade, whether you're trading £1,000 or £1 million. In fact, at £1 million, you get a far better rate. But up the tens of thousands, it's only £12.50, or with the broker I'm with now, £7.50. So you can swap from one to the next for 15 quid. There's also a little bit of stamp duty when you buy. It's 0.5% in the UK. But online is massively cheaper and has freed up the market enormously. I'm sure you'd agree with that, Martin, from the point of view of the UK. Stop losses. Most brokers will allow you, if you have, for example, 1,000 Vodafone shares at £1.80, they will allow you to put a marker in there anywhere you like £1.50 or £1.40. If they fall down there, they will sell for you automatically. So if you happen to be enjoying yourself in Dubai or in the Caribbean and the market falls, you will at least get out. I would advise a word of caution. At the end of a day's trading, the market goes wild as the brokers close their positions. And if you've got something a little bit down, you'll lose the shares. I'll give you a guarantee on that. Okay, know the annual dividend. It is important to me, and I have some papers which I'll give you in a few minutes. Ah, here we are. Thank you. Yeah. Actually, yeah, that's fine. Okay, and the other ones, if I may. Karen, okay? That's only the presentation for you. A stock will trade for a year, identify the profit, and then declare a dividend, yeah? Which will be paid during the following year. Normally, after a quarter, they pay 1/3, and after 3 quarters, they pay 2/3. So the big dividend is on the second time. The shares will, in a flat market, rise up as they accrue the dividend. That gives me the option of waiting to take the dividend or selling when the shares are dividend heavy. The point being that in the UK now, most people get £10,000 earned income tax-free, but they also get £10,000 of capital gains tax-free. So if your income is sufficiently high, it's a better thing to take the money as a capital gain, which will save you. Everybody understand that, or do you broadly get the principle? And the funny thing is that a dividend being paid, for example, on the 1st of May, the stock will go XD, in other words, you qualify for the dividend, on the 1st of April, about 4 weeks before. The dividend price will then drop by the amount of the dividend, all depending on market shares. Martin?
The share price, not the dividend.
Sorry, the share price will drop when it goes XD. The funny thing I find is that when people have received the dividend, the stock price drops again. I don't know why, but that is normally a buying opportunity. Okay, the other points on here, if you have identified a share that is worth buying and you buy it at a price, say £1 or €1, and it drops down to 80, if it's still worth buying, buy some more. You then have a lower average price and the possibility of making even more money. Other points that I make that I'll be saying more about: attend annual general meetings if you can. You can't beat looking at the directors in the eyes to see if he can meet yours or not, and you learn a lot at AGMs. The importance of watching your portfolios. These are shares that I personally have owned at the appropriate dates. Yeah? The purple or mauve ones over here no longer exist in that form. So you have to keep watching. Back in 1976, ICI, ICL, a major computer company, Kloof Gold Mine, De Beers, Johannesburg Consolidated Mines, all of that lot have moved on. You cannot just leave for 40 years. In 1990, I was already into Racal, which became Vodafone, and I still, in fact, they're my largest holding at the moment. And I still have BP. They would have done better, but America got a president about whom my comments are beyond the scope of this recording thing. Rolls-Royce, to sell them was a mistake, because I still think they are a major growth share in the United Kingdom. They are winning the engine battle, and the market remains colossal. They are, however, quite high. I'm not going to go through them all. I sold Shell not that long ago. I bought RTZ as recently as last September at £27, and I sold them in January at 35, shortly before they had a little glitch in their profits. They're back down to 30. My buying point is 28. So to keep watching is, to me, important. No need necessarily to go into the others. Many of the others are utilities. They sell gas and water and electricity, and they are things that very few people can do without. And subject to the fact that the British energy policy is clearly run by idiots, and there are risks there, those shares all pay more than 5% and are very steady and would normally be recommended. The Drax Group are the largest power station in Great Britain, and they now are converting fast to biomass. They buy chips of wood from Texas and Kentucky because there are licensing problems in getting the millions of tons of felled timber out of the Scottish, English and Welsh forests. It's an amazing situation. But Drax are considered green, and again, I could recommend them. Okay, and I'll take questions at any time, by the way.
The utilities are subject to regulations.
Yes.
And regulators are reasonably independent.
Yes.
And sometimes rather maverick.
Absolutely true. Absolutely true. Yeah. But you can read all that in the papers.
Only once they've become maverick. We may be a bit late.
This is true. This is true. So, moving on just a little, increasing earnings would be a factor in buying any sensible share. My own real experience is that recovery stocks don't very often. Okay? You need to be aware if you're buying a recovery stock that you're taking a gamble. An optimistic chairman, again, you have to see him saying it. And you also need, of course, to have read his annual report and perhaps analyze it or had it analyzed by someone in your shareholders group to find out the quality of the lies that he's telling. For example, at the Aviva meeting last year, the chairman stood up and said they'd had a very good year and were looking forward to a better year this year, which is now finished, of course. In fact, his board of directors had over 4 years helped themselves to 304 million, but they had destroyed 22.5 billion of share value, including 3.5 billion in the year which had been so very good. I had a question for him, okay, which was, you've lost 3.5 billion in the last 12 months. How long will it take you to lose the next 3.5 billion, because you've only 2 of them left? He mumbled and sat down, and the CEO left the following morning, entirely because of my efforts. Moving down a little bit to family-controlled shares, that would be a negative. If a family has control of the shares, I would not normally consider buying that. If you don't have any form of democracy, okay, there are other opinions, but that's never a positive thing. Exceptional factors you need to look at when somebody has discovered something. One of our directors bought a share a couple of years ago, and it was in the computer area. It has gone up 97 times because they developed something which was sold to a customer and then sold to 1 million other customers. Well, these things are very difficult to spot, and you do need insider knowledge, and that is difficult to get unless you're actually a banker. 1 or 2 little comments from Warren Buffett, for example. We embrace the 21st century by entering such cutting-edge industries as brick, carpet, insulation, and paint. I agree with that philosophy. Keep it simple, do something that you know, stick to your knitting is a British phrase that applies to that. Don't get too far away from it. Another, it's easy to forget that ownership of a share is not a lottery ticket. It is part ownership of a business. And when you sit down at the AGM, remember you are the owner, the people up there are your employees, yeah? And incidentally, if they have not done well, you don't have to be nice and polite. Tell the chairman to get them off. About 15 years ago, I was at a lawn row meeting when someone did exactly that. He named every director and explained why he should be got off the board. Boringly, the following year, not one of these men was on the board. So I think, apart from anything else, he was right. And another one from Buffett, my favorite time frame for holding a share is forever. So, quite a good one. Research. Investors Chronicle is only one of several publications that are available in the UK. My private view is that it's the best, and I take it in, by subscription, because it really covers every stock. And when you know the writers within it, and you do need to understand whether they are any good. Yeah, it is worthwhile reading. Websites all have masses of information. The one that I'm now getting involved in is Stockopedia, where they do a very thorough analysis. I'll be passing this on in just a few minutes, of a stock, and will be a definite switch off if it's not worth buying, because everything is in here. Investors Chronicle, Stockopedia, yeah. You have to pay for it, by the way. It's 180 quid a year. Absolutely worth it if you've got anything. I'll cover more of that later. The stockbrokers like Self-Trade, like Share Stock Limited, and the other big British stockbrokers all have their own. Most of them stream the data from the big suppliers like Bloomberg. Okay, so they're all dealing with the same information, and you don't necessarily get it any earlier. In relation to information, the companies in Britain have to declare their news on a certain day and have it in the market by 7 a.m. You can get it in your own computers at 7:05. My own experience of that is that that gives you time to react by the time the stockbrokers get in at 9 and the ordinary blokes get out of the bed, walk up for the paper, feed the dog and read it. By that time you can have traded on the news. So that would also be a factor. Moving on a little, your average investor in the UK holds stock in unit and investment trusts, and I will be talking about that very soon. He buys through his bank. Yeah, I have never bought a share through my bank, and I happen not to trust any of them at all. The average investor is looking for quick returns. Yeah, I would say I'm not. I'm interested in beating inflation every time with a little bit more if possible. Some companies issue shares. They are nearly always a very, very good thing to take up. Okay, it's a subsidy, it is part of your income actually, and it could put people who are not normal investors into certain tax-free gains. That would always be a good thing to do. Sadly, most of the directors who cash in their long-term executive plans sell as soon as they get them. And I personally look at what the directors have been given from the annual report and bring it up at the annual general meetings that these directors have received a total of 100,000 shares, but I notice the total is the same as last year. Therefore, they have sold them at once. What is the point of having them? A pleasingly embarrassing question for an unprepared chairman. We had a big privatization at the time of Prime Minister Thatcher. She sold 23 government enterprises, created 9 million shareholders. They rocketed away, but after 25 years, in fact, they are no longer there. Very many of the companies have merged, they've been taken over, they've been taken out, and none of the new shareholders traded very much. And when they die, the people who inherit sell the shares. So it did not create a big shareholding democracy. By the way, I find that sad, but you're back into, oh, I trust my bank, and oh, I can't be bothered looking after my money. I'd rather watch the people with muddy boots. The average direct investor might be advised by his bank. He follow newspaper tipsters, and one or two of them in the large papers are not bad. They can't afford to be. They tend to be fairly cautious, and I couldn't condemn them. They listen to friends in the pub, however. When they have a profit, they sell. I always sell when they've gone up 30%. Yeah? And they hold on to losses. Don't worry, they'll come back. Wrong thinking. The share has no memory. It doesn't know what you paid for it. Yeah? If it goes down, get out, would be a point. But they may eventually become a good investor who joins ShareSoc or AXA, okay, who reads annual reports, attends AGMs, asks questions, may get invited to analyst-style meetings, which happen before the AGMs, okay, this is not insider trading, in the law. Get to know the directors. It's amazing how many of them turn up again and again. The average non-executive director has far too many directorships, and I would always vote against the reappointment of a non-executive director who has 3 or more non-executive directorships, because they can't keep up to date if they have that many. It is just not possible. So I was explaining to Guillaume that many of them put people they were at prep school with. Prep school in the UK is under the age of 11, and they're still feeding them money because of that. Yeah? Deals in online execution only, which gets the prices right down, although you have a major problem in getting voting rights if you deal online. We and AXA are working hard with the government to try and fix this. I do not see an early resolution. Apparently the Americans do this much better. We have some investors with American stocks, and they say it absolutely flows through properly. Yeah, Keith Haldane is a case in point. Okay, understanding the problem of costs and of holding funds. I am not in favor of having shares in investment trusts, in unit trusts, and open-ended investment companies because of the cost. This is a little bit into inflation. Over 100 years, yeah, if you invest in equities, a £1 share would have gone by 2012 to £142. In real terms, actually it's 7,800 in deflated money. Gilts is worth £1 still. Gilts are a very bad investment unless you can get them so depressed that they're paying about 14%. It has happened twice in my lifetime. If you invest the income, that pound would have been worth nearly £1 million. Okay? I took these figures.
When did the investment start?
1912. Okay?
100 years.
Okay. Yes, yeah. I took these out of a magazine, the Money magazine, and I therefore am not going to try to defend them. But what I am going to do is look at this. Most trusts have 6. I think I may have... you have all the papers. So I'll get you to have a look at some of these soon. Yeah. The average gain about 3 years ago was 1.2% on the market. The dividends were 4%. The total return 5.2, quite nice. At a 1.5% of fees, okay, you're getting 3.7. 1.5%. Here is a magazine produced by a very good stockbroker, Hargreaves Lansdowne of Bristol, full of funds. Every one claims an annual charge of 1.5%. Take a look at what that means. Just to cover another little point, you buy investment trusts so that you get an immediate spread. Okay? You can spread your risk. These are some income stocks, and those are among the top 11 shares that they all own. 9 of these 10, I think there are, have Vodafone, 8 have Glaxo, 7 have BP, HSBC, and Shell. Where's the spread? You, as an individual investor, with not too much money, say 10,000 quid, can have all 10. You would pay £15 or maybe £7.50 to buy each one, and from then on they will send you money at the rate of more than 5% per annum forever. Just to come on a little bit with that, those are the top 10 at the moment. Pardon my little typo, and there was a spelling mistake everywhere. Anybody notice it? Yes. Yeah, that's right. There was another one. I spelt Vodafone with a PH. This is to do with the 8th wonder of the world, compound interest. Yeah? And I would invite you to take this sheet with which you have just been issued. This is the most complex part of my presentation, and I'm trying to make it as easy as I can so that I can understand it too.
I need my glasses.
Yes, indeed. I can get you a tumbler, but that's the best I can do. It works on the basis of 20 cigarettes a day for a number of years. In Britain, 20 cigarettes are about £7. I do believe they're cheaper in Europe. Okay? But
In continental Europe.
the other side of the channel. Indeed, yeah. But at £7 a day, it's £2,555 a year. If a young chap starts smoking behind the bike sheds, okay, with his money from the paper round, does paper round mean a thing in Europe? Delivering papers? If he didn't do that, but invested it, the company would, if it were an investment trust, would take £38.33 of his 2,600, a very reasonable sum for investing that amount of money. I really mean that. Yes? If he does it in the second year, he gets up to line 2 on your chart, and he is worth, assuming a 5% yield, £5,500. If he has put it in an investment trust taking 1.5%, he's now getting 5,300, and the investment trust for an extra 2,500 is taking £118. To cut straight to the end, assuming a 50-year cycle, when he retires at 65, if he's invested in shares at 5%, he's worth 561,000. Which means, of course, if he marries the little girl he was abusing behind the sheds, he's a millionaire. Okay? If he, yes, if he invests it in an investment trust, that is worth 346,000, and the investment trust has had 215,000 of that money. Can you explain to me where my arithmetic is wrong? No? Just to show that graphically, blue is what is earned, purple is what the investment trusters get, and yellow is their fee. The chart in your hand is quite useful, because if someone says, what will it be worth if I start now in 10 years' time? You just have to reset the start date. It's all on this. I have included on the sheet an 8%, which some people claim, coming back to 6.5%, and a 10%. Anybody who promises you a 10% on an investment for a long term is lying. It cannot be done for a long time.
Madoff did.
But not for a long time. He didn't do it for, yes he did. How long?
Well, a couple of years.
And an earlier chap called Ponzi
So, yeah.
said, yeah, but they were, as discussed, liars, yes?
They were.
So there are a few figures for you. By the way, that is not higher mathematics. That is very simple arithmetic, okay? I saw fit, using a stockbroker's calculator, to compare some of these figures with the interest worked out on a daily basis, and I was within less than 1% of his figures. So simple arithmetic is all you need to do this. So, any questions on those figures at this stage?
They are very clear. Yeah.
Thank you. Moving on a little bit more.
You should have mentioned it's compounding.
Of course it's compound, and it's also reinvesting the income, and it is also not allowing for inflation.
Yeah.
So this is an illustration, that's all. Yeah?
For taxation.
The £1 million at the end will only buy a couple of pounds of mince and some rice.
It's also tax-free.
Yes, it's also tax-free, which it would be in the UK till you get up to about here anyway.
But the conclusion is, if I understood correctly, is you should keep smoking.
I'm surprised you can't look out the window when you're facing that way. You missed that little bit. Yeah? But as a matter of interest, you could do all of this within the ISA system and pay zero tax on it,
Yeah.
actually. So that is not quite wrong. Our activities, and AXAs are not that different, informed meetings. This is a sample of what we issue every month at our annual meetings, at our monthly meetings with certain companies. I'll pass it around you just to show, if you like, the quality of the stuff that we are able to do, giving an analysis in this case of 3 companies, compared in the first 2 or 3 pages on this with a Stockopedia. Yeah, keep turning. That's for your own notes. Yes, and I will lend you a pen.
Thank you very much.
Okay. We are deeply involved in getting the voting rights back to the nominee shareholders, who are always the more dynamic shareholders. They don't just sit there, they go to meetings. It is so sad that they now have to spend so much time digging out the dates. I think one of the reasons is that company directors do not like private shareholders' questions, which are not normally of a pleasant nature. Venture capital buyouts. There was a tax-free situation with venture capital trusts recently. Matter of interest, most of them did not succeed. And the directors now are trying to do a parcel buyout of theirs so they can keep all the money. Share buybacks, we normally, in fact, we always vote against. If they have earned that money, they should give it back to shareholders, not buy shares. And most of the big companies, including certainly BP, Aviva, AstraZeneca, and Vodafone, have spent billions of their own money buying back shares, which incidentally have promptly fallen. So we are very strongly against that. And education, where to start? As we've already covered, buy direct. Yeah. Split the risk, know your companies, and you will beat the fund managers. Fund managers also have other restrictions. If one of the shares that they don't hold joins the FTSE 100, they have to buy that share. Yeah? The trackers all do. Equally, if they fall, they have to sell that share. No question of keeping it for that. You don't have to do that as a private investor. So, my final comment is good luck and good investing. I now invite questions from the floor.
Thank you very much.
Thank you. The one other thing that I gave is a portfolio. It is not actually mine, but it's someone that I advise, and the quantities have a multiplier on them. You have to decide whether that's an up multiplier or a down multiplier. The reason that I show it is that this would be a working document for me, which would enable me to check the price against the price for a profit, when it goes ex-dividend, giving me the right to take the dividend, and when the dividend is paid. Interim first, and then the final dividend. How much is the dividend is in the column at the second last one. And that might be the amount that I would like the share to fall if I'm going to buy some more. So it's a working document.
What does PFP mean?
Price for profit. In other words, what I paid for it, or what this person paid for it.
Price is the current price.
Price is the current price.
Price for profit is the
Purchase price.
purchase price.
Okay. The number of shares.
Number of shares.
Price times number equals value. Okay. Showing the profit. Okay.
The level of the dividend.
The level of the dividend is over there. Actually, this was taken from an older portfolio for obvious reasons, and BP were not allowed to give a dividend by some jumped up chap in America
And that's the XD.
for a while. XD is ex-dividend 1 and ex-dividend 2. Div is when the dividend was paid. And the figure at the end is the yield on the starting price. In other words, the yield on the price for profit.
Yeah. But
Okay.
you have quite more than 3 months or between the X date and the dividend.
Well, there's a reason for that, because I didn't have room, but BP pay 4 dividends a year, not 2.
Okay.
Okay, that's why. So yes, well spotted, but that is absolutely the reason. Okay, any questions?
Yeah. Did you ever buy non-British stocks?
The answer is we bought African mining shares, but they were listed in London. And I have, within the last 3 years, owned Shell, which of course is largely a Netherlands stock nowadays. Where are the Netherlands? Oh, they know it all already. Yeah? Yes, but no. The culture of buying stocks in Britain is not much in favor of going abroad. I was talking to Jella yesterday. Investors Chronicle recommends at the moment only 2 German stocks, Volkswagen and Heidelberg Cement. As a general rule, we don't do it because we can't read the annual general reports. Getting to the AGMs is difficult, okay? Nothing personal, but it's just more difficult.
That's why we have EuroFinUse.
Yeah.
Exactly.
Yes.
That's the reason.
I agree. I agree.
Interestingly, in 1939, according to my father's share book, all his shares were overseas, significantly in South America,
Yeah? Yeah, sure.
as Mrs. Kirshner reminds us.
Indeed.
Yes, yes.
How about American stocks?
American stocks.
Because it's only don't have a language problem.
No, yeah. America has a different set of problems. Yes?
You mentioned fund management and mutual funds, quoting that they usually charge 1.5% of the value as management fee. But you didn't mention the impact of UCITS and the fact that when funds grow, they become index funds, regardless of what they brand themselves.
Yes. Yeah. No.
Is that something we should perhaps go out and tell our members? Because as you indicated in the bottom, a fund can be a good way of spreading risk and lower cost.
Yeah.
But if you pay 1.5% for just running an index fund, it's a rip-off.
Yeah. Yeah. No.
I was going to mention this because, in fact, Stan did it a bit when he showed this slide on pseudo spread, showing that most big active funds, they were investing in the same share. But I agree with most of the principles you are putting, but even Warren Buffett, he recommended, because you are quoting Warren Buffett a few times, he said for an average investor, going for a basic index fund is not such a bad idea. The big difference with usual funds you showed is that the fee is very small, and even professional asset managers, if they want to spread the risk, as you mentioned, is a good thing. For example, if they want to invest in emerging stock, they don't know, even themselves, they don't have the time to investigate, and they would buy, for example, an index fund in emerging stock. So I think my caveat to your principles would be, if you want really to spread risk and to seize opportunities, especially abroad or in areas you absolutely don't know, to have stocks, direct stocks on the one hand, but also some index funds in the asset classes or regions you don't know might not be a bad idea for the average investor, because when I see all your presentation, I am a bit afraid that being the right type of investor is a full-time job. And the problem is...
yes, getting on for it.
Yeah.
I can't dispute that. Okay.
But not everybody can spend his whole time investing.
No. The point is, how much time do you have to spend to be a proper investor? Manage an hour a day?
From what
I would say.
It's quite clear.
Yeah, but I also...
How much time do you devote to your investments?
a couple of hours every morning.
Every morning.
Yeah, that's more or less what I do.
You're misspelling about replicating index.
No, yeah.
Go online and replicate index.
Yeah.
Yeah,
And no analysis,
Yeah.
nothing to replicate.
A number...
As you said, when you are replicating index, you may be obliged to buy a share that is just coming into the index, and then to sell the other share because it's going out.
Yeah.
And you don't want to do it because maybe the one that is entering into the index is not a good one, and the one that is leaving the index could be still a good buy. So
Yeah.
you're passive. You are very passive.
Or you can replicate fund.
Yeah.
You can follow fund manager sections. And
Well, that's exactly what you would be doing.
But when you say replicate, that has a very interesting link to where you started in the comments, and that is foreign shares. Because when you compare different markets or exchanges, the explanation, or most of the explanation for the different performance, is actually the weighting of the sectors. And should you just buy British shares weighted according to CAC 40, you will have a British portfolio that performs very, very close to CAC 40, because all these big companies are international. They sell in the same market, they produce in the same market. So you can have a domestic global portfolio.
Yes.
If you choose to do that. Very cheap.
No, by the way, I agree with that. Just to come back to you, Willie, American shares I know have done very well, okay? But starting knowledge has not been good for me.
I have two questions. First of all, you say that you advise people. Are you allowed to do so?
I do not. The answer is no. I'm not allowed to advise them on what shares to buy. And as a rule, I don't. Okay?
Yeah.
No, you're absolutely dead right. Nowadays, it's controlled. The other point is, of course, that my advice is always free. Yeah, not even a bottle of whiskey is acceptable. Although it might be a reason for that. Another comment I'd make in relation to funds. Many years ago, I attended a course on investments run by a mathematics professor. And the bottom line was take your money, put 40% in a tracker, put 40% in a general investment trust like foreign and colonial, and put 20% in stocks and shares and watch it disappear, was what he said. Yeah? So that is also...
I know a better one. Put 1/3 in weapons, 1/3 in alcohol, and 1/3 in cigarettes.
The other comment I'd make in relation to these figures here is that the best performers have been tobacco. But I can't stand the smell, and I never buy them at all. Yeah, you're right.
My second question is, you were talking about your successes. What about the losses?
In my own case, most of the failures have been in small companies, with the exception of the British banks. Okay, well, 4 or 5 years ago. Sorry?
What about BP?
I've lost a little bit in BP, but I still hold them, and not much. And now they're paying the dividends again, so that one may come back. The British banks, of course, were a total disgrace, and it'll be many a long day before I even consider buying a banking share. Yeah. So those are the failures.
So you entered BP, you bought shares of BP after the disaster in the States?
No.
It went down?
Yes, it did.
Few
Yeah,
times and
yeah. No, should have. Should have. Many of my friends have made a lot of money by buying back the bank shares recently. But I'd rather seek newer, possibly greener pastures. Okay? But it's not about me, it's about investing principles. Any other questions? How do you handle your own people who come to you and say in your national organization, tell us about stocks and shares?
How do you convert people from the naive group to the experienced group? Because as you say, we all recognize that amateurs tend to go for the Sputnik that shall go sky high,
yeah,
and concentrate on one share. And we would like to see more of the Belgian dentist or a portfolio managing concept. Yeah. How do you sell that?
Well, get them to join the shareholders group, get them to read the letters if they're computer literate, get them to read the letters that are printed, okay, and keep them coming to meetings. That's it. Always answer their questions.
To follow up on Yves' question, first I thank you very much. I think very interesting to see, as you titled it, the shareholder culture in the UK, especially as we view in the rest of Europe, you know, over the channel, we view the UK as the country of birth of capitalism and share and stock markets, etc. And I was struck when you said you gave the outcome of the Thatcher privatization program. In France, the smaller privatization program, I think, would give similar, unfortunately, similar results.
Yeah.
But what is your estimate of the nowadays? And you said number of shareholders was declining.
Yes.
What would be your estimate of the percentage of people who are direct shareholders in the UK?
I'm not sure I have a figure for that. Have you, Martin?
Because we have
6% possibly?
I was going to say 5, but
5 or 6, yeah. The figure 6 comes to mind.
It's very low.
Oh yeah.
We have at the Financial Services User Group of the Commission, we just commissioned a study on the evolution of EU companies' ownership over the last 40 years. And our assumption is that we started in the 50s at maybe 40 or 50% of the big listed companies in Europe, including the UK, were owned by
yes.
individuals. And probably nowadays, we'll see, but maybe 10 to 15, or it could be even lower if you say in the UK it's 6. I think probably it's roughly the same in many countries. So it's quite a concern, not only for us as a shareholder group, but also for the democracy, because it means that more and more the economy is owned by intermediaries, financial intermediaries, instead of real investors.
Yes, yes, absolutely right. I think one of the biggest problems is if you go to anybody who's going to give advice, he is undoubtedly, or she is undoubtedly going to say, well, good thing that you've come to someone to give you advice, okay? Because although we're certainly no better than the guys at Share Soccer, yeah, we'll at least give you advice, and we'll do this for only 1.5%. Yeah? Sure.
Then you should perhaps respond as I did in the comment in our house journal. Somebody asked there, shall I pay 100 quid a year for advice on investing? And I said, no. I wrote, no, you shouldn't. I suggest you use half of that money as the annual contribution to Aktiespararen instead and read our magazine.
Yeah.
Use the remaining 50% to go out and have a good dinner, because that will give you a much better return per year.
First class advice, yeah. One of the points about the 1.5% is that I think it's in year 48 that the fees exactly eat the whole of the 26.82 that they paid for the first one. They've then had all of it. Yeah? These figures are actually terrifying. Right, how are we doing? No more questions? Ladies, gentlemen? Okay. I declare this meeting adjourned. Thank you.